Declan. Okay, thanks very much, Declan, and hello everybody. Nice to see so many familiar names again through the window. I don't always recognize the faces, but I do recognize the names certainly. So hopefully we're all friends. And for those of you that I was not working with in the spring or the summer, you're very welcome aboard, and looking forward to working with you between now and Christmas and on into January. So which seems a long way away, but it'll be with us before we know it. So anyway, so either way, great to see you again, or great to talk to you for the first time. Okay. For those of you that don't know me, by way of introduction, my name is Paul Daly. I've moved away from the credit and collections world in the last few years, and I'm now doing something else. But prior to that, I was working for a total of 14 years in either a credit or collections capacity, and sometimes the two at the same time. I worked for Oracle. That's where I cut my teeth in the credit and collections world. Then moved on to Philips, and then for most of that time, I've been working with Accenture, working with one of their diamond clients for over a decade, steering them through the various challenges, including the financial crash in 2008. So, and I suppose most importantly, many years ago, around about that 2008 period, I was sitting, it wasn't virtual back then, but I was sitting where you were sitting, and I was a student of Declan's. So I did this course myself many years ago. And I've been working with Declan, I suppose, for a little bit over 10 years at this stage. Okay, so that's just a quick introduction as to myself. So in terms of what we're going to cover off, I suppose this is a whistle-stop tour. We're not going to go through any sort of detail. You don't need to take any notes. It's just to give you a bit of a guide as to what it is that's going to be coming up for you over the next number of weeks and months. So we'll get right into it. So when we're talking about credit, credit is a very powerful tool in business. It allows a lot more sales to happen than would happen otherwise. Okay, so that is one of the reasons, and that is always the reason that you should offer credit. If you can sell more by offering credit, you should do it. If you don't need to offer credit in order to sell more, it's debatable whether or not you would need to do it. Okay. But in order to make sure that credit is the powerful tool that it is, it needs to be managed in the correct way. Okay, if you manage it well, it is very powerful and it will make you more money. If you manage it badly, you will lose money as a result. So it is important to manage it in the correct manner. So the model that Declan has developed that we follow throughout this course in order to help you manage your credit and collections activities is what is known as the ATTACK model. Okay. ATTACK, attack, okay? And each of the letters stands for a word, okay? So the first A stands for assessment, okay, which we'll be talking more about in a minute. We're going to cover that off in module 1. The two T's stand for terms and conditions and teamwork. We're going to be covering those off in module 3. The second A stands for administration, which we'll be covering off in module 2. The C stands for collections, because you can't really have credit without successful collections. That's covered in module 4. And then lastly, we have key performance indicators, which is the K, and that is also covered in module 2. Okay, so the ATTACK model is what we are going to be focusing on throughout the 4 modules that we cover. Okay. So the first A is assessment, and we're covering that off in module 1. Okay, so what are we talking about in terms of assessment? The word credit comes from the word credere in Latin, which means to trust. Okay, so we're asking ourselves, who are we trusting? Okay, so there's 4 key questions that we're asking when we are asking ourselves, who are our customer? Okay, so who are we trusting with our money? How much do we think we can trust them with? How long can we trust them for? And are they willing and able to pay the full amount back when the due date comes around? Okay. So in terms of who are we trusting, we need to ask ourselves, okay, well, who are our customer? Okay. There is a way of dealing with all sorts of customers. There's very few that you might necessarily want to avoid altogether. Most of them you can work with, but you just need to pick the correct strategy to work with them. Okay. So when you're asking yourself who you're trusting, you need to ask yourself, okay, well, what is this customer? Okay. Are they a sole leader? Okay, are they 2 people operating out of a living room, or are they a big multinational with buildings all over the world and thousands of employees? Okay, both of them are fine to work with, but you just need to know which is it. Okay, is it a sole trader? Okay, the key thing about a sole trader is, if you're dealing with a sole trader, is they essentially are the business. Okay, if they have a big fancy car and they have a big house up on the hill, in theory, if things go wrong, that house on the hill and the nice car out front can potentially be used to discharge the debts. Okay. If, however, on the other hand, they are a limited company, That car and that house may well be in the name of a director of the company, but the director is separate to the company. Okay. If the car and the house are owned by the company, they are assets you can potentially use to discharge debts if they go wrong. If they, however, belong to the director and they are in his or her name and have nothing to do with the company, they are not up for grabs, even if things go very, very badly wrong. So you need to ask yourself what type of customer you're dealing with. Is it a limited company? Is it a public company? Is it a sole trader? Is it a partnership? There are advantages and disadvantages of each, and we cover all of them off in the notes. Okay. So the question might be, okay, well, how do we get this information? How do we find out, are they a sole trader? And how do we find out other types of information that is useful to making our decision? And the answer is our credit application form. Okay, so you may well be familiar with the credit application form. There's lots of questions on it, names, addresses, phone numbers, and lots of different information. There's a reason behind each of the questions that are there. Okay, and within reason, you want to find out as much as you can without necessarily putting the person off and saying, okay, this is too much. This is too difficult. I'm not going to bother. Okay. In my world, there's three things. There's lots of different, there's maybe 20, 30 things you can ask on a credit application form, probably more. But there's three key things that we're looking out for. Okay. The first one is we're trying to get as much credit information as we can reasonably get from the customer. Okay. We want to find out the type of company. Okay. We want to find out the type of business. Okay. Are they selling a product that's up and coming and is definitely going to be a success? Or are they selling something that's up and coming that's maybe very risky? Are they selling an outdated product, like maybe typewriters that are maybe on the way out? How many employees do they have? Do they own the buildings? That kind of stuff, okay? So lots of credit information within reason, as much as we can find out is useful, okay? Because that way you can decide, is it good to lend them money or not, okay? You're also going to look out for things that will stop you getting paid, okay? So do they use PO numbers, okay? If they use PO numbers, you'll be asking that. If they don't use PO numbers, for instance, you'll be asking them on the credit application form if they do or not. If you could just bear with me 1 second, that would be great. Okay, thanks. Sorry. Okay, so the second thing you're looking out for is, what are things that might be excuses to stop them paying on time? Okay, and the biggest one that I've always found over the years has been, well, there's no PO number on there. If you could dig out the credit application form and say, well, you said you didn't need PO numbers on your application form, doesn't necessarily make it impossible for them to still delay in terms of paying, but it does make it a little bit harder. Okay. And then the third and final thing that I'm always looking out for in credit application forms is lots of contact details. Okay, if things go wrong, you want to be able to reach them. So do you have email addresses? Do you have more than one email address? Do you have phone numbers? Is the phone number maybe a direct line? And somebody in one of the exams a couple of years ago, discussing a question on credit application form, suggested a brilliant idea, which was when you get the credit application form, test the numbers, test the email addresses, make sure they work. Are they generic email addresses that are accounts payable at such and such a company.ie, or are they a little bit more specific? Okay, there's positives and negatives to that, but ideally you want a number of different opportunities to contact them. Okay, so those are all things that you're going to put in the credit application form. Okay. After you've established who you're trusting, you then ask yourself, okay, well, how much am I going to trust them with? Is it a crowded market? Like I said, is it an up and coming product that may be risky? Is it an established product? Is it a product that's on the way down? How long is the company in business? All those type of things are useful to establish. You may get some of them from the credit application form. You may need to research others, but these are all questions that you need to be asking. Okay, so that's just a flavor of the type of stuff that we'll be covering off in the assessment part, which is all in module 1. Anyone have any questions on that? Nope. Super. Okay. So we're going to move on to module 2. Module 2, it doesn't go sequentially, so we don't cover off the 2 T's, which are teamwork and terms and conditions. We don't cover them until module 3. What we do in module 2 is we cover off the second A, which is administration, and we also cover off key performance indicators, which is the K. Or in other words, the reporting side of your credit and collections activities. So if we focus on the administration first, it is very important to say, a lot of people might think, certainly when I started in collections, I kind of thought, okay, if you have good collectors and a good collections process, that's going to be enough to get all the money in. And it'd be great if that were the case. But the reality is that's not really the case. You need to own and monitor the entire order to cash process before you're going to be successful in collections. If even one of those steps is badly out of sync, you are going to run into problems when it comes to collecting money at the end of the process. So some of the questions that you need to be asking yourself in the order to cash process are these. Okay, there's a number of lists in the notes, but I'll just go through this first one quickly. You need to ask yourself, have you a list of potential customers? Have you an action plan to contact those customers? How do you ensure that all orders are recorded so they don't get stuff for free? How do you ensure that all orders are delivered? How do you ensure all deliveries are invoiced? How do you ensure all invoices make it onto your debtor's ledger? How do you ensure that all invoices are on the right account on your debtor's ledger? How do you ensure that all cash is posted to the correct account? How do you ensure all cash is posted against the correct invoices? Have you a way of dealing with disputes and part paid invoices? How do you ensure all customer accounts are correct? Have you a mechanism for checking your statement every day? And have you a mechanism for checking have you a mechanism for checking that every statement is correct before you send it? And have you a mechanism for checking that checking your bank account every single day in order to see whether payment has been received or not? Okay, all very, very important. If one of those falls apart, it might be well outside of your inverted commas remit, but it is going to impact you in terms of collecting cash. That's guaranteed. Okay, so we're going to take you through all that. Okay. The first area we focus on is documentation. We're going to talk to you about your credit notes and your invoices, how to make them look in a manner in which gets you to the top of the pile. Okay, if you're an accounts payable and you see an invoice that's easy and straightforward and you can easily work out what it's for, it'll go to the top of the pile and be paid quickly. If it's difficult, it goes to the bottom of the pile to be dealt with when I have a bit more time. And if that's the case, then it's it's going to be slower in terms of getting paid. We're going to talk to you what your statements should look like. Okay. And one of the questions in the multiple choice tests that you're going to be doing throughout the term is, well, how many different columns should there be in the statement? Okay, in terms of due, overdue, and so on. There should only really be two. There should be due and there should be overdue. If you put in a column for 30 plus, 60 plus, 90 plus, 360 plus, what you're saying is you're sending a message to your customers. Some of our customers only pay us after a year. Okay, which is a bad thing to be sending to your customers because they might say, well, okay, maybe I can become one of those customers. Okay, so I'm going to take you through what your statements should look like. Okay, let's see, what else do we cover off in module 2? We're going to talk to you about your reporting. Okay, so the reporting key performance indicators. Okay, well, sorry, before we get on to that, we're going to talk to you about things that you need to check. Okay, a big part of collections and also credit is checking, rather than checking stuff for half a day once a month, it's doing a maybe 10-minute check on everything once a day. Okay, quick check on a lot of different things every day will give you an early heads up if things are going in the wrong direction. Okay, so every day you should be checking your bank account, your unallocated cash, your invoices to make sure they're going out and that they're right. Okay, there's certain things that you need to check every week, and some people maybe only check them every month. They should be doing them weekly. Things like their high risk accounts, maybe the credit notes, and analyzing them as to why they're happening. And then there's things you should be checking every month. Okay, and if you get into a good habit of checking these things when they should be checked and regularly, your opportunity to get your cash in faster is significantly better. Okay, you're always in competition with other suppliers for cash. Okay, very few companies pay everything on time. Okay, not very many do that. Okay, so you're always in competition with the other suppliers out there, and if you manage your process better, you're more likely to get paid before they are. Okay, we're going to take you through the variety of different payment types that there are. Okay, so things might, if you think of payment types, things might come to mind like bank transfers, direct debits, maybe even cash, which is beginning, but that's in quick decline. But there are many others. I think there's kind of 23, 24 that are called out in the notes. So we're going to take you through all that as well. Okay. All right. Okay. Any questions on any of that? Okay, very good. So let me see, just before I move on to module 3, I think I'll just take a moment on the K part of that, the actual reporting side. So it's very important to kind of say, I mean, as any of you who've worked in collections or credit for a while will know, it's not the world's easiest job. Okay, and it's not the world's most thankful job either. There can be days where it feels a bit thankless, that you're the kind of bad guy in a world that's going well for sales and marketing and so on. So it is important to report things in a certain way. Okay, so one of the things we're going to show you in module 2 is how to report further up into the organization to people who may not necessarily have a credit and collections background. Okay, rather than reporting potentially that 5% of the accounts are overdue, you may want to report that 95% of them are within their payment terms. Okay, suddenly the message sounds an awful lot better. Okay, but there are certain ways of reporting things that are more positive than others. So there's words like, rather than using credit limit, we use the term credit line. Okay, credit line suggests that you have a bit of money to spend. It suggests that sales have money, a budget that they can bill into for the customer. A credit limit is immediately a bit more negative. So we're going to take you through all of those types of words, the right words to use when you're talking to non-credit collections people, to put the best foot forward and to put the most positive spin on the good work that you're doing. Okay. Any questions before we go to module 3? Okay, so module 3 is a meaty enough one. There's we don't spend necessarily too long on any of the individual topics in module 3, but there's quite a few of them in it. Okay. So the first thing we're going to cover off, what we said we are going to do in module 3 is we're going to do the 2 T's. Okay, so terms and conditions and then teamwork. So terms and conditions, first of all. The most common term and condition, certainly that I've seen over the years, that gets misinterpreted is the credit terms. Okay. How long do you actually have to pay? Okay, because a lot of people will say, well, you have 30 days, or you have 45 days, or you have 60 days. That's the message that'll be given. Okay, but the problem is what the customer hears is different. Okay, the customer hears 30 days, they hear 45, they hear 60. They say, all right, they'll say, right, what's the thing that happens last? Okay, maybe it's when the invoice arrives. I'm going to take it 60 days from the invoice. Okay, so is it 30 days from the date of the order, 30 days from the date the order is dispatched, 30 days when it's delivered? You need to be clear and be very crystal clear with your customer. Okay, this is the due date. It is 30 days and it is from this event. Okay, because believe me, they will always take the longest they possibly can to pay it. I will do it myself if I'm a customer. You need to set the correct credit terms. Okay, so there's no point. I do know years ago, I worked for a client and we started ramping up our business in the Middle East. And I think we talked initially about maybe 30-day, 45-day credit terms, and we were kind of laughed out of the room because there's no, you need at least 90 days in that region. Okay, in order to grow your business. So there are certain factors to take into account. Can you afford to go to 90 days is one thing. What are your cash flow requirements? Do you have maybe other customers who maybe are not as big, or maybe sell faster moving products that maybe you can reduce the credit terms? Maybe you offer different credit terms depending on the size of the customer. How strong are your customers? What are the competition doing? All those things play a role in how much, in how long you give before you actually look for the money back. Okay, but that is important. I mean, clarifying it is very, very important. That's probably the more important of the two. But getting it right in the first place and not looking for payments every 7 days when in reality there's no way you're going to get them in every 7 days is important in terms of getting things getting payments in on time. We're going to take you through what the most common terms and conditions mistakes are. Okay, so a lot of times, when things start going wrong, people start reaching for the fine print and start saying, "Oh, it says it here." If the customer is not aware of it, or if you haven't drawn attention to it, or if they never even got it, you are going to find it more difficult to enforce your terms and conditions. So we're going to talk to you about common mistakes in the terms and in setting your terms and conditions, which will prevent you getting paid on time. We're going to take you through what is known as Incoterms. Okay, so Incoterms deal with deal with international trading, and they deal with when the question that an Incoterm is asking is, when does the supplier's responsibility for the goods end, and when does the buyer's responsibility start? Okay, so at one extreme, you can have a scenario where you say, "This is my warehouse, come and collect your goods," and if the buyer drops the goods 10 feet from the warehouse, the feedback is, well, unfortunately, that's now your problem because you took them out of the warehouse. There is the other extreme, which is where you will deliver the goods. So if the person delivering the goods drops them 10 feet from the delivery destination, the supplier is still on the hook. Okay, so they will be covered in your on your invoices, or should be covered on your invoices if you're involved in shipping physical goods internationally. So we're going to talk to you about that in module 3. Next thing we cover off module 3, like I said, it's a meeting of modules, a few things in it, is the company's credit policy. Okay, the credit policy basically is, I won't call it a rule book, it's kind of more like a playbook, okay, as to how you handle the entire order to cash process. Okay, you may have seen scenarios over the years where somebody says, right, I'm sick of that customer, I'm going to put them on hold. That's not really the way it should work. It should be clearly defined. Okay, if you go, if a customer reaches X days overdue, that they go on hold. I mean, you can apply some discretion. Yes, that's fine, but it should be a case of customers should routinely, unless there's mitigating circumstances, should routinely be going on hold at a certain date, not before and not after. Okay, so it's a playbook on all things. So I mean, it covers, who signs off on the credit limits, how does the billing happen, what reports are going to be generated into the business. It runs as a playbook for the whole order to cash process. So we're going to talk you through how to devise your credit policy, or what should be in your credit policy if you already have one. Okay. And that finishes us on the terms and conditions. If we move on to the teamwork stuff, I suppose I'll pause for a moment. Any questions on the terms and conditions before I move on to teamwork? Okay, great. So we have the second T to cover off, and then lastly in module 4 we have the collections one. The collections one's not as heavy as module 3, so a little bit shorter. Okay, so we're doing well. We got 4 out of 6 in the word attack done. So the second T, it's for teamwork. Okay, and obviously, it'd be kind of nice if it might be nice if we worked in isolation in the credit and collections world, and the whole world saw things the way we do, but that's not really the case. So you are going to need to work with other departments, and there's probably not many people on the call who've ever worked in the credit collections world who have not had at least an argument with sales at one point or another. Okay, and possibly more. I can see 1 or 2 people smiling, so that must have happened. Okay, I know it used to happen to me pretty much on a weekly basis, but the argument side is not necessarily a foregone conclusion. Okay, there are ways of working with sales. An example of how to work with sales, which might be flipping things a little bit on its head, is, the old-fashioned model is that the orders start coming in, and every so often an order gets blocked because either a customer is over their credit and they've reached their line of credit limit, or they've gone overdue in it. Okay, so and then the order's gone hold, and then sales get on the phone and kind of, you are a bad man, Paul, what is it you're doing, and you're ruining my business, and so on. So those are the discussions that begin to happen. Okay, so to start off on kind of a negative front, if we flip it on its head, a better way of working with sales, which would be great if you can make it work, is that sales will give you the heads up and say, right, this month these are the customers I am targeting to reach my sales target. Okay, and you can then go and have a look and say, yes, these ones are green, they're up to date, and they're a long way from their credit limit. These ones are amber, because they're coming close to their credit limit, or the due date is coming up and so far there's no promise to pay. And these ones are red, they're already overdue, or they're already over their credit limit, so you're going to have a problem. And you can work with sales so that you can get the sales through. The aim is always to get the sale through, if it's for the right type of customer. Okay, and under the right conditions. Okay, so working with sales can make it very, very helpful. Okay, but sales are one of the teams you're going to have to work with. Okay, marketing is another. Okay, the best example I can always come up with is, a number of years ago, a client said, we are going to make significant inroads into Africa, because it was the only continent where they had not made significant inroads in terms of business. Okay, what they didn't, but the ask was to apply a European collections model to Africa, in order to collect the money. Okay, which does not work. Okay, in a lot of countries in Africa, the way to do business is face to face. Okay, so in the end, we ended up getting a team of collectors which we hired, and we positioned them strategically in Africa so that they could go and they would spend a lot of time on the road and go and visit the customers. Okay, and we weren't selling; these were big deals. Okay, so we weren't selling kind of invoice. There were no invoices of kind of €100 or something like that. There were more invoices of maybe $1 million. Okay, so it made financial sense to have that. But you do want to work with marketing. You don't want marketing surprise and say, "Oh, good news! This is something we're doing," and you're not ready for such an event. Okay. You need to work with operations. Okay, a couple of reasons you need to work with operations is you want the billing to be right, 100 as close to 100% of the time as it can be. Okay, realistically. Okay, you want it right first time. Okay, and when it goes wrong and you need a credit note, you want those credit notes issued quickly. You don't want to be battling them and saying, okay, well, yeah, we'll only do it when we have some overtime or some spare capacity or the beginning of the month. If you have a close working relationship with operations, they will need you to release the orders if they go on hold, so that you can get the billing done. Okay. In return, what you should be asking from them is that they always have strict things in place to allow them to bill correctly first time round. And in the event that things do go wrong, that they fix them and fix them quickly. Okay. And finally, you're also going to need to work with service departments. Okay. Years and years ago, I worked on the customer service lines in Citibank. If an account came up that was overdue, a thing would flash on the screen, and I would be nice to the customer and so on, but then I would transfer them through to my colleagues in collections. Okay. So before I didn't spend half an hour giving brilliant service to a customer that was overdue. We sorted out the overdue first bit, and then they would pass it back. Then collections would pass it back, and we would sort out whatever query it was that they had. Okay. So it is important that you work well with your service departments. Okay. And then the last thing, let me see, is it the last thing in module 3? I'm scrolling through the end. It is. So the last thing in module 3 is we are going to show you how to calculate your DSO, your days sales outstanding. Okay. Which you may or may not have encountered. But essentially, your days sales outstanding is telling you, at its simplest, it is telling you how long it is taking for you to get paid. Okay. So if your debtor's ledger is $1 million, well, let's say, no, yeah, if your debtor's ledger is, say, 2 million, and you are billing approximately 1 million every month, it's basically taking you 2 months to get paid. Okay, we're now the middle of September. If you have 2 million on your debtor's ledger, you're billing $1 million a month. By now you have cleared everything that came in, in the first half of July. Okay, not customer by customer. Okay, but just if we take your entire debtor's ledger as one big number. Okay, it's basically taking you 2 months to get paid. Okay, which if your credit terms are, say, around 60 days, is pretty good. Okay. If, however, your debtor's ledger is, if we take a better example, let's say your debtor's ledger is $500,000, okay, and you're still billing about $1 million a month, your DSO could be as low as 15 days. Okay, I'm simplifying a bit, but essentially that's half a month's worth of billing that is still sitting in unpaid. Okay, that means your DSO is closer to 15 days. There's a number of different ways of calculating it. There's a number of different scenarios in it. We will take you through that in module 3. But that is a key calculation. Varies from company to company, but it's a very good calculation that allows you to compare company by company. Because if you're a company like Microsoft and they have $1 million in overdue, that's not necessarily a big deal because they might be billing 10 billion a year. Okay. If you have $1 million in overdue and you're only billing $1 million a year, then you have a year's worth of debt there. So comparing $1 million versus $1 million is not necessarily a good way of doing it. Comparing one DSO against another is actually, and saying, well, these are the credit terms, that is actually a pretty good way of comparing how one company is doing versus another. Okay. So there's a lot in module 3, as I said. We give you a bit of the time back in module 4. It's a little bit softer, although it's dealing with maybe more negative topics. But I will come to those negative topics in 1 second. But any questions on module 3, either on the teamwork or the terms and conditions? Okie doke. So let me see. So the last one, the one letter that we haven't done yet is C, which is for collections. Okay. Now I see a lot of people, as I said, I see a lot of familiar names on the call. So you guys will have done a detailed collections module, not with me, but you will have done it. In the spring or in the summertime. Or most of you will. So we're not going down through that. I mean, that deals with things like kind of what is the tone and the pitch and so on, and some of the good words and bad words to use in a collections call. We're not doing that in this. What we are dealing with more is the stuff on the side. Okay, mainly when things have kind of fully broken down. But just before we get to that, a couple of things we cover off in module 4. We deal with building relationships. Okay, so we carry on. At the end of module 3, just before we do the DSO, we're talking about kind of how do you work with marketing and sales and all that. We're now talking about how you build relationships, good working relationship with your customers, okay? Because the better relationship you have with your customer, the more likely you are to get paid. Declan always says people pay people they like, okay? So that is something worth keeping in mind. Something I could maybe share with some of my relatives at times. Yeah, I think they like me, but I'm always the last get paid if they owe me money. But anyway, I digress. We cover off things like shouldn't pay, can't pay, and won't pay. Okay, so very important to be able to classify what type of customer you're dealing with. Okay, the approach for can't pay needs to be completely different to the approach of shouldn't pay. Okay. and again with Won't Pay. Okay, so you have different approaches of that. You may have seen some of that before in the collections module. We're going to be covering that again in the collections part of the credit management module. Okay, so we deal with that. Okay. We will be looking at customer visits again. Okay, so you will have touched on it in a bit of detail, maybe not as much detail as you have here, but we touched on it in a bit of detail in the international credit one, which again, some of you will have done over the last few months. We're going to be revisiting some of that and going into a bit more detail as to how it is that you should be dealing with your customer visits. And the rest of the module is dealing with what happens when things go, you reach the end of the process, you've done your collections calls, you've tried your customer visits, you've done your very, very best, but you're just not able to collect the debt, either because they can't, frequently because they can't pay, or other scenarios. What are the other options you can go through? So we're going to take you through how to do things like financial reviews with customers, so you can assess, okay, well, is there a long-term future for our business relationship? How you deal with third-party debt collection. Okay, so say you've reached a stage where, okay, you can go no further and you hand it over to a debt collection agency, and maybe they pay you, maybe they take a cut of every 100 euros that they recover. We're going to give you some guidance as to what happens if you go down through the legal routes. Okay, so what's the best way to handle that? Okay, I think you did some of the legal kind of side of things internationally right at the end for your final assignment, but we're going to take you through how to go down the legal route if you need to do that. What to do if your customer goes into liquidation. What to do if you want to pursue an avenue in terms of receivership. Talked at the beginning of the call about seizing the nice car or the house at the top of the hill. So how you might go about doing that. What to do if your company is put into examinership or administration, and then finally how to handle creditors meetings. Okay, so all practical stuff that you're not necessarily going to deal with every day, but you probably won't go with your entire collections or credit collections life without encountering. So so very useful guidance, and good to have that saved away for even for a year or two's time when it might become an issue, not in terms of the course, but in terms of your professional working life. So that's what we're going to be covering off. We've got 4 short tests throughout the course, which Declan, I think Declan told you about, and we have a couple of assignments as well. They will make up 30% of your mark. Then the remaining 70% will come from the exam, which you will be doing in January. And that's about all I have for me.
Thanks, Paul. Yeah, short, sweet, and hopefully we haven't terrified you now at this stage in terms of the work. And I know when you're getting it all in one lump, it all seems, oh my God, it is very doable. And I hope that from a credit management perspective, it is, it's practical advice, and I'm hoping it's stuff that you can put into action on a day-to-day basis, and that's really the point of this as well. That yes, there is some academic stuff because you'll never do it or you're not doing it at the moment. It's a logical step in terms of credit management, getting from the start to the finish and filling in the gaps. So hopefully you will enjoy it. And I suppose the good news is, Paul, you've finished 9 minutes early. So fair play to you for that. So what we will do now is let's take a break now. So I will now stop the recording.